Now, let us start with first and the foremost whenever we are dealing in foreign exchange, that is FEMA, Foreign Exchange Management Act. So, I will tell you brief about Foreign Exchange Management Act also, and I will tell you how this Foreign Exchange Management Act evolved. What was how? Why did it was enacted in India? Friends, as you know both these personality, Mr. Yashwant Sinha and Dr. Manmohan Singh. Both were the finance minister of India. And I will take back to you to 1990 when Yashwant Sinha was the finance minister of India and he had to pledge tons of gold in tons of gold with Bank of England to get foreign exchange loan. Immediately after that, general election took place in India. Mr. Narasimha Rao became the Prime Minister of India and he made Dr. Manmohan Singh, a non-political person, as Finance Minister of India. And immediately after assuming charge of Finance Minister of India, Dr. Manmohan Singh also had to pledge tons of gold with Union Bank of Switzerland to get foreign exchange loan. Friends, why the position has arisen at that point of time? That nobody, neither World Bank, IMF, no other country, no other bank was willing to give loan to India, and India had to pledge tons of gold to get foreign exchange loan. So, friends, why this position has arisen at that time? At that time, the position of India was as the position of India of Sri Lanka a few years back. And what is the position of Pakistan right now? So, for why this position has arisen, for knowing that thing, I am taking you still back to the time when India got independence. When India got independence, at that time, the dilemma before our political leaders was what type of economic structure to adopt. There are two types of economic structure. One is capitalism, other is socialism. In capitalism, the wealth and the power of the country remains in the hands of few in few hands, and they oppress and suppress the general masses. And the impression of British Raj was very very fresh in the minds of our political leaders, and because we had seen this slavery for the last 200 years. And in Britain, the capitalistic form of economic structure is being adopted. So our political leader ruled out that we will not adopt capitalism in our country. And in socialism, the wealth of the nation is equitably distributed among all its citizens. Equitably means as per requirement of each citizen. And in our neighborhood also there are two countries, USSR and China. They were adopting the socialistic form of economic structure. So our political leader thought that we fought together to get independence for India, and after independence, all the citizens will enjoy the fruits of independence together. So our political leaders adopted socialism, socialistic form of economic structure. In the preamble of our country also, in the preamble of our constitution also, it is written, India is a socialist, secular, democratic republic. So friends, in socialism, like USSR and like China, there are certain tenets, there are certain principles which is adopted, which are adopted. And our political leaders adopted these certain tenets, which were they? One is protectionism. That, that our economic boundaries will be very strong. there will not be any competition with outside world. Whatever we want to produce, we will produce in India. Whatever we want to consume, we will produce in India. There will not be any FII or FDI, no foreign institutional investment, no foreign direct investment. So, friends, because they thought that first companies like East India Company will come to India to do business, and later on that company will make our country a slave. So there will not be any FII or FDI in India. Next tenet is import substitution industrialization. Means if anything is required in India and it is not produced in India, that item will not be imported from outside. No. We will create, we will manufacture these substituted item and we will use it. There was no emphasis on exports. Exports, there was no emphasis, friends. Export, whether there are exports or no exports, no matter, but there will not be any import. There was more emphasis on forex conservation. There was no emphasis on forex earning. Whether we earn foreign exchange or not, but whatever foreign exchange we are having, we will conserve it. And next is central planning. Like USSR, like China, we also adopted 5-year plans. So before the start of 5 year, for the next 5 year, what will be the economic activities into the country? That 5-year plan will be prepared, and that 5-year plan will be approved from the cabinet. That 5-year plan will be approved from the parliament, and for the next 5 years, that country economic activity will go strictly as per 5-year plan. And to ensure that all the economic activities are going as strictly as per 5-year plan. So it was said that if anybody want to start any industry, anybody want to put up any factory, they have to obtain permission from the government official. And the government official used to give certain licenses. So that era was called license Raj era. Now, and there is, because there was no economy per se in India. So economy was required to be built from the scratches. And to build that economy, there was no capital in the hands of the private sector. There were only two houses, Tata and Birla. No other private sector was there. And the entire onus, entire burden of building the economy was on the government. So government can collect taxes from the citizens, and by collecting taxes, they could put certain industries. So to build the economy, government started putting up public sector units, public sector undertakings. So when public sector undertakings was being put up, because one public sector undertaking is being put up, a number of ancillary units will also be put up. So if one public sector undertaking is put up, in that case, you can say that lot of undertaking economic activity will start. So because public sector undertakings, what is that? Government was doing business by setting up public sector undertakings. So at that time, our industrialist J.R.D. Tata, he advised the then Prime Minister of India, Mr. Jawaharlal Nehru, that please, you are putting up public sector undertakings, please ensure these public sector undertakings remain profitable venture. They keep on earning profit, not incur losses. At that time, the then Prime Minister replied to J.R.D. Tata, never talk to me about profit. It is a dirty word. Means country is putting up public sector undertaking not to earn profit, but to do social welfare, but to build economy. So, friends, whatever happens, what was the result of any action, what is the outcome of any decision we take, it is we come to know slightly later on. So what was the outcome of these policies of protectionism, import substitution, industrialization, central planning and state intervention? All these things can be summed up in the words of Mr. J.R.D. Tata when he spoke on Indian regulatory system in 1969. Friends, what did J.R.D. Tata said? I cannot decide how much to borrow. Means individual person, individual industry, individual group cannot decide how much to borrow because who will decide? Government of India. I cannot decide how much to borrow, what shares to issue, what at what price, what wages and bonus to pay, and what dividend to give. I even need the government's permission for the salary I pay to a senior executive. Means for all activities, government permission was required. So, friends, this was the result of all these activities. Now, coming back, due to these things due to these policies, this was the outcome as described by Mr. J.R.D. Tata. But in 1999-2000, when India was facing precarious position of foreign exchange reserves, at that time, when one difficulty comes, it doesn't come alone. A number of difficulties, number of problems, number of adversities come together. At that time, two major tragedies happened on the world hemisphere which shook the economy of the India. So, what were those two tragedies? One was disintegration of USSR in 1991. What was that? Means USSR was broken into 15 pieces and Russia was the biggest country. India was already not having any international trade with any other country except USSR. USSR was our best friend. When USSR got disintegrated, whatever international trade India was having, so it also stopped, totally stopped. And another tragedy was Gulf War in 1991 when Iraq captured Kuwait and Russia, USA did not like this thing and USA attacked on Iraq. Due to that Gulf War, the prices of oil went manifold high. India is always a net importer of oil, and to import the oil, foreign exchange is required. India was also finding difficulty in foreign exchange. It was the position of foreign exchange was very low. India was having foreign exchange for 1 week oil import, 1 week import only. So when the prices of oil went high, at that time India could not import oil and Indian economy came to a grinding halt. At that time, India approached IMF once again. Please give us some loan. So IMF agreed to give a loan of $5.5 billion, but with certain conditions. What were those conditions? Number one, reduction in import tariff. India custom duty on import was too high. Why? Because India wanted to discourage import. So IMF said you reduce your import tariff at par with the other countries in the world, developed countries in the world, so that goods can be exported from other country to India. Indian can also import those goods. So it should be at par with the other countries. So reduce it. Number two, is reduction of taxes. India tax structure was too high, too high. So if anybody is earning even after independence, there was a point when India direct tax, not in 1991, but before that, when the direct tax was as high as, income tax was as high as 94%. If anybody was earning 100 rupees, he had to pay, if he's in highest bracket slab, he had to pay 94 rupees tax. If any company, outside company, overseas company, set up a company, a unit in India, and if it earns profit, they had to pay 94% tax. So at that time, also 1991 also, the tax structure of India was too high. So they, IMF put a condition, you reduce your tax structure at par with the developed countries, at par with other countries in the world. So that if any company from outside, any industry come from outside, they set up industry over here, so they need not pay higher amount of taxes. It is a viable proposition for them. Then greater foreign investment. India should allow FII, foreign institutional investment, FDI, foreign direct investment into India. So that companies from outside, they can invest in India. Then there was a deregulation of market. You deregulate your market, friends. Yeah, what IMF said at that time, up from independence up to 1990, the rate of interest of banks was decided by Reserve Bank of India. What will be the rate of interest on deposit? What will be the rate of interest on advances? All was decided by Reserve Bank of India, not by individual banks. So, friends, if any bank is accepting any deposit, he will give rate of interest rate to that depositor as decided by Reserve Bank of India. If he is giving any loan, he will charge that much amount of interest which is being decided by Reserve Bank of India. So there was a perfect competition in banking structure. You go to any bank, same rate of interest on deposit, same rate of interest on advances used to be there. He said, you deregulate, let the rate of interest be decided by the market forces, demand and supply. So India started the process of deregulation of interest rate. First, it started deregulating deposit rate, then it came to advances rate. As you know, BPLR system, base rate system, MCLR system, now external benchmark lending system. So these are the outcome of these deregulation of interest rate structure. And now, another market, foreign exchange market, at that up to 1990, the conversion rate of foreign currency like US dollar was decided by Reserve Bank of India. Banks were not deciding the conversion rate of US dollars. So at that time in 1990, the the rate of $1 was decided by Reserve Bank of India as 12 rupees. If means if I want to purchase $1 or if I want to sell $1, so the rate was decided by Reserve Bank of India at 12 rupees. Supposing at that time I wanted to go on a foreign trip, at that time basic travel quota regime was there. Means Reserve Bank used to decide how much dollar I can get from the banking structure if I am going on a personal trip. How much dollar can I get from the banking structure if I am going for a business trip, or I'm going for a medical trip, or I'm going for an educational purpose. So all these things were decided by Reserve Bank of India under basic travel quota. So nowadays, liberalized remittance scheme has come that anybody can remit funds up to $250,000 every year, irrespective of the purpose. At that time in 1990, if I was required to go to USA or a foreign trip, So I was entitled to get $500 under basic travel quota from the banking system. And for that matter, also, first I was required to go to Reserve Bank of India to get license. Once I get the license, I get the permit. Then I used to go to a bank and to get $500, and that bank used to give me dollar at the rate of 12 rupees a dollar. Means by paying 60,000 rupees, I could get $500 from a banking system. But I knew that if I go out of the country, I need at least $2,000. So $500 I have got from the banking system. Rest of the $1,500 I could have got from the grey market, from the black market that was very, very active in India. So dollar in the grey market was also easily available, but at the rate of 20 rupees a dollar. So what was the impact of controlled rate of 12 rupees and black rate of 20 rupees? That all our NRIs, non-resident Indians who are sitting outside India, if they remitted funds through banking channel, then bank used to give them 12 rupees a dollar. But if they were remitting funds through Hawala channels, or whenever they were coming, and they by hiding certain dollar in their pocket, they were coming in India and selling in the grey market, they used to get 20 rupees a dollar. So all those NRIs, they were keeping their funds outside India. They were not remitting funds to India through banking channel. So friends, our exporters also, what they exported, they also used to export goods out of India, and they used to under invoice it. Means $1 lakh exports was being done, goods of $1 lakh was being exported, but invoices were made for $50,000. So that they were keeping $50,000 by selling goods in USA there, and they were sending those $50,000 through grey market. So friends, when this foreign exchange market was also deregulated, at that time, the rates of foreign exchange, when rates of foreign exchange was being decided by market forces, demand and supply, the rate of foreign exchange dollar did not remain at 12 rupees, nor it remained at 20 rupees. It came somewhere around 17 rupees. Somewhere around 17 rupees. So now the black market was totally abolished. Now our NRIs who are keeping funds outside India, they thought it unviable to keep funds outside India. So they started remitting foreign exchange to India through banking channel, because keeping funds in USA is less remunerative. Why? Because keeping funds in US bank does not give any interest, and keeping funds in Indian bank, they could have earned interest over it. So they started remitting funds to India, remitting funds to India. Even exporters also, we started remitting funds to India, those who are holding their funds outside India. So India, who was facing the problem of scarcity of foreign exchange, all of a sudden the problem shifted to plenty of foreign exchange. When the problem shifted, from scarcity to plenty, and so we also required to change the law also. Earlier we were having FERA, Foreign Exchange Regulation Act. Now we need to required to change from FERA to FEMA, Foreign Exchange Management Act. Now it was no more required to regulate it, foreign exchange market. It was required to manage it. So Foreign Exchange Management Act 1999. It is an act of the Parliament to consolidate and amend the law relating to foreign exchange with the objective of facilitating external trade and payments, and for promoting the orderly development and maintenance of foreign exchange market in India. So friends, because it replaced FERA, FERA which was in India since 1973. In 1999, Foreign Exchange Management Act came into being. So it was implemented in India with effect from 1st June 2000. So what is the difference between FERA and FEMA? FERA was a disabling bank. When it used to say banks, you can't do this thing, you can't do this thing, you can't do that act, you can't do that action. It was totally disabling. And FEMA is an enabling act. It specifies that banks can do this action, they can do they can do this type of transaction. It is an enabling bank. Objective of FERA was conservation of foreign exchange. Means foreign exchange was required to be conserved, and the objective is FEMA is to manage the foreign exchange. FERA dealt with problem of scarcity of foreign exchange, whereas FEMA deals with the problem of plenty of foreign exchange. Friends, offense under FEMA was criminal and punishable, and burden of proof was on the accused. If police arrested someone under violation of FERA, then the person who is arrested, he was required to prove that he is an innocent person. Police was not required to prove that he is an accused. Whereas in FEMA, offense under FEMA is civil and compoundable. It is not criminal. And burden of proof is on the prosecution. If police arrest anyone for violation of FEMA, it is the duty of the police to prove that that person who has been arrested is really an accused. That person is not required to prove that that person is an innocent. And current and capital account terms were not defined under FEMA. What is current account? What is capital account? We had already discussed in our first session. And current account and capital account are clearly defined under FEMA. Friends, so let us know something more about FEMA. Foreign Exchange Management Act 1999. It was implemented with effect from 1st of June 2000, replacing previous Foreign Exchange Regulation Act, FERA. It consolidate and amend laws relating to foreign exchange. It facilitate external trade and payment, and it has been enacted to promote the orderly development and maintenance of foreign exchange market in India. It extends to whole of India. It also applies to all branches, offices outside India owned or controlled by a resident in India. There are 49 sections in this act, and regulatory requirement under FEMA are resident and non-resident individuals, resident and non-resident entities. Friends, foreign exchange as per FEMA. What is foreign exchange? First of all, we're talking about foreign exchange, foreign exchange, foreign exchange. But what is foreign exchange? Foreign exchange constitute foreign currency, including deposits, credits, and balance payable in any foreign currency. Any draft, traveler check, letter of credit, or bill of exchange expressed or drawn in Indian currency but payable in any foreign currency also constitute foreign exchange. Any draft, traveler check, letter of credit, or bill of exchange drawn by banks and institutions or persons outside India but payable in Indian currencies also foreign exchange. In other words, foreign exchange constitutes stock, including foreign currency assets, balance kept abroad, instrument payable in foreign currency, and instrument drawn abroad but payable in Indian currency. Friends, there are certain important provisions under FEMA. There are 49 sections, but I'm telling you certain very important sections. Section 2 of FEMA tells about the definition of foreign exchange. Section 3 of FEMA says no entity other than one authorized by Reserve Bank of India can handle foreign exchange business. Means if you want to handle foreign exchange business, you have to be authorized by Reserve Bank of India. Section 5 of foreign FEMA says it deals with current account transaction. We have already explained you current account transaction. Section 6 of FEMA deals with capital account transaction. We have already explained you capital account transaction. Section 10 of FEMA, what does it say? That RBI may, on an application made to it, authorize any person to be known as authorized person who can deal in foreign exchange or in the foreign securities as authorized dealer or as money changer or as offshore banking unit or in any other manner as it deems fit. Friends, section 11 of FEMA, what does it say? That RBI authorized to issue RBI is authorized to issue directions, call for information and impose penalty. RBI has got the right. If anybody is violating FEMA, RBI can impose penalty. Section 12 of FEMA, what does it say? It empowers Reserve Bank of India to inspect the authorized dealers. They can inspect the records of authorized dealers. Section 13 of FEMA, it deals with contravention as civil offense and to impose penalty. Section 36 of FEMA provides for establishment of Directorate of Enforcement, ED. So FEMA, RBI can provide for establishment of Directorate of Enforcement. Section 46 of FEMA empowers central government to frame rules. Section 47 of FEMA, it empowers Reserve Bank of India to make regulations to carry out provisions of this enactment. So friends, now there are certain FEMA provisions which affect the international trade. These are Section 7 of FEMA. What does Section 7 of FEMA says? That what can be it deals with exports of goods and services. What does it say? It says every exporter of goods shall furnish to Reserve Bank of India or such other authority. What does it furnish? A declaration in such form and in such manner as may be specified. Should this declaration contain? It should contain true and correct material, particularly including the amount representing the full export value. What does Section 8 of FEMA says? Section 8 of FEMA deals with realization of export proceeds. Realization. What does it say? Where any amount of foreign exchange is due or has accrued to any person resident in India. If somebody has earned any foreign exchange, how he will deal it? Such person shall take all reasonable steps to realize and repatriate to India. Exporters have done exports. Now it is the duty of exporters to realize and repatriate to India such foreign exchange within such period and in such manner as may be specified by Reserve Bank of India. Friends, now that what are the Section 11? Section 11 of FEMA, it says about the mandate of Reserve Bank of India. What does it say? It says Reserve Bank of India by regulations. They can make regulations, Reserve Bank. By regulation, Reserve Bank of India can prohibit, restrict, or regulate the certain transaction between resident and non-resident persons or entities. What can be those transactions? Like transfer or issue of securities. Means RBI can make regulations how the transfer and issue of securities can take place between resident and non-resident. Borrowing and lending in foreign exchange or Indian rupee. And how the deposits and investment can be made across the countries, how the export, import, holding of currencies can be done, and how the transfer, acquisition of immovable properties across the boundaries can be done, and guarantees in respect of any debt, obligation, or other liabilities. RBI is empowered to notify regulations to give effect the FEMA through which type of guidelines? APDIR series circular. If you see APDIR circulars, these contains regulations of Reserve Bank of India under FEMA. Consolidated instructions of underlying circulars notifications are issued through master direction. RBI issues master directions, also master circular also. So this is all these master directions are consolidated instruction during the year. Every time RBI issuing direction through APDIR, and then on 1st of April, 1st of July, it issues master directions. It consolidates all the circulars earlier issued, and submission of various transaction report to RBI. What type of report an authorized dealer will submit to Reserve Bank of India? It gives mandate. Friends, now section 10 of FEMA, it deals with categories of authorized dealers. So when RBI can authorize, permit somebody to deal in foreign exchange, and what type of that entity will be there? That entity will be called authorized dealer. But what type of authorized person will be there? What type of authorized dealer he will be there? There are 4 types of authorized dealers. Authorized dealers category 1. What does it say? That commercial banks dealing in foreign exchange. Authorized dealer category 1 certificate is given to all the commercial banks who deal in foreign exchange. Authorized dealer category 2 is given to cooperative banks and regional rural bank dealing in foreign exchange. Authorized dealer category 3 is given to is given to selected financial and other institutions dealing in foreign exchange. Authorized money changers, there may be full-fledged money changer, there may be restricted money changer, friends. Now, what are if RBI is given permission to deal in foreign exchange to a person, he is called authorized person or authorized dealer? What will be the duties of that authorized person, and what will be the powers of that authorized person? Duties are that that authorized person will comply with RBI direction. Whatever RBI gives direction from time to time, they will have to comply with that. And number 2, not to engage in unauthorized transaction. They will not be dealing with any unauthorized transaction. Ensure compliance of FEMA provisions. They will have to deal with the they will have to comply with the FEMA provisions, and they will have to produce books and accounts whenever Reserve Bank officials come for inspection. Powers. What are the powers to the authorized dealers? To deal or transfer any foreign exchange. Means They can deal or they can transfer any amount of foreign exchange. They can receive payment by order and they can open NRI accounts also. They can sell, purchase for current or permissible capital account transaction. Friends, in conclusion, if we go forward, FEMA is a statutory basis for exchange control. It is the statutory basis. If you are dealing in foreign exchange, you have to understand, you have to full knowledge about FEMA. Any violation of FEMA can be a civil offense. So friends, if you don't violate any FEMA, otherwise it will be treated as a civil offense. FEMA permits only authorized persons to deal in foreign exchange. No other person other than authorized by Reserve Bank of India can deal in foreign exchange. So these authorized persons will be called authorized dealers, money changers, offshore banking units, or any other person prohibited by Reserve Bank of India. RBI strongly enforces foreign exchange laws effectively, friends. Yes. So, friends, with this, I have discussed the provisions of FEMA.